Something happened in the silver market this past week that the majority of investors are going to hear about 3 months from now, after the biggest part of the move is already gone. Right now, silver has crossed above $94 an ounce, and for the first time during this entire rally, the road to $100 is not just possible. It is structurally open. Nothing is standing in the way. Not one major resistance level, not one significant supply zone, not one technical barrier that price has to fight through before it reaches triple digits. That kind of setup is rare, and when it appears, it does not stick around long. So if you have been watching silver from the sidelines, or if you are already positioned and wondering what this breakout actually means for what comes next, you are in exactly the right place. Stay with this, because what I am about to walk you through goes way deeper than the surface level price move that everybody else is reporting on. We are going to cover the technical structure that just got created, the mechanical reason the dollar is acting like rocket fuel for silver, a jaw-dropping event at the COMEX that almost nobody in the mainstream is explaining properly, and a volatility danger hiding right underneath this rally that is going to destroy thousands of traders even if silver hits 100 exactly like they predicted. Before we go any further, if you have been finding real value in the market breakdowns we do here on Element Axis, take 3 seconds and hit that subscribe button right now. Most people who watch these videos consistently have not subscribed yet. And I get it, you can always find the content without doing it. But that one click keeps this channel going and makes sure you never miss an analysis when markets are moving this fast. If these breakdowns are helping you think more clearly about your money, go ahead and do that now and then come right back. Also follow Element Axis on Twitter for real-time updates when things break overnight. All right, let's get into it. Let's start with what actually happened, because the headline number alone does not tell you why this moment is different from other silver rallies you have seen come and go. Silver just pushed above $91.33, which had been acting as a hard ceiling for weeks. Every time price tested that level, sellers showed up and pushed it back down. And then this week, silver did not just poke above it. It broke through with enough force that the ceiling flipped. It became a floor. That is a significant technical event. And when you look at what is sitting above current prices after that breakout, you find something traders call a price vacuum. A price vacuum is exactly what it sounds like. It is a zone where there is no friction, no clusters of sellers waiting at specific levels, no historical congestion areas where lots of buyers and sellers previously traded hands. A vacuum is open air. Price can move through it quickly because there is nobody standing in the way. And right now, between roughly $94 and the $100 psychological level, the chart shows almost nothing. No meaningful supply, no overhead resistance, just a clear technical runway. Now, I want to be straight with you about something, because I think a lot of channels oversimplify this kind of setup. A clear technical path to 100 does not mean silver gets there by next Tuesday. It does not mean the move is guaranteed. What it means is that the market structure has removed the usual friction that slows rallies down. If buyers maintain pressure and the forces driving this move stay intact, price can travel quickly through that vacuum. But if those forces shift, that same vacuum works against you on the downside just as fast. So understanding what is actually driving this move is not optional. It is essential. And the most important force right now is something most people are not paying close enough attention to. It is the dollar. Specifically, what is happening to the dollar structurally, not just in the headlines. The dollar index has been declining because 10-year Treasury yields have dropped to their lowest level in nearly 3 months. And when Treasury yields fall, something mechanical happens that directly benefits silver. The interest rate differential between holding dollars and holding other currencies shrinks. As that differential shrinks, the cost of owning an asset like silver, which pays no interest, no dividend, nothing, goes down relative to simply parking money in a yield-bearing account. Think about how this feels in real life. If your savings account is paying you 5% annually, holding silver that generates 0 return looks expensive. You're giving up 5% per year to own metal. But if your savings account drops to 2%, the math changes completely. Capital that was staying in dollar-denominated accounts because the yield was attractive starts looking for other homes. Some of that capital flows directly into precious metals. That is not speculation. That is a mechanical, structural relationship. And it is one of the main engines running underneath this rally right now. What you have as a result is a dual engine setup. On one side, dollar weakness and falling yields are providing the macro tailwind, the fundamental reason for capital to flow towards silver. On the other side, geopolitical risk in the Middle East is providing the immediate emotional catalyst. When both engines are running simultaneously, moves can be powerful and fast, but dual engines can both stall at the same time. A sudden shift in either driver can send price moving as fast in reverse as it moved forward. Keep that in mind. Let me ask you something, and I genuinely want your answer in the comments. When you think about the dollar's weakness right now, do you see it as temporary, driven by short-term events? Or do you believe this is a structural, longer-term shift in how the dollar is valued relative to hard assets? Your answer fundamentally shapes how you should be thinking about silver. If it is temporary, this is a trading opportunity. If it is structural, you are repositioning entirely, treating every pullback as an entry rather than a warning. Drop your honest thinking below because it helps everyone watching to see how this community is processing the macro picture. Now, let's talk about the COMEX situation because this is where the story gets genuinely alarming. For anyone who has trusted that the paper price of silver reflects physical reality. A single sell order for 159 million ounces of silver hit the market this week. That number is so large, relative to what actually exists in deliverable form, that the system itself could not handle it. Trading halted. Here's the context you need. The total registered inventory at COMEX, meaning the silver physically sitting in approved vaults and actually available for delivery right now, is under 60 million ounces. Someone tried to transact 3 times the available deliverable supply in a single order. The market froze. And what that moment revealed, right there in plain sight, is the fracture line that has been quietly growing for years between the paper price and the physical reality of silver. For a long time, the paper silver market has operated on one comfortable assumption. Most people trading silver futures are not actually trying to get the metal. They settle in cash. They roll contracts forward. They never ask for delivery. As long as that assumption holds, you can have a system where paper promises significantly exceed the physical metal that backs them. It works until it does not. When someone sends an order for 159 million ounces into a market where 60 million ounces are deliverable, the system shows you exactly how thin the ice has become. What makes this timing particularly significant is that March delivery notice day was approaching when this happened. That is the point in the futures cycle when contract holders must declare whether they want actual physical delivery or whether they are rolling forward. With registered stocks at these depressed levels, that notice day becomes a genuine stress test for the entire system. I am not predicting COMEX collapses. What I am telling you is that the physical silver market is tighter than it has been since the 1970s. That is what the inventory data shows. And when physical markets get this tight, paper prices eventually get forced to reflect reality. The only question is when and how violent that adjustment becomes. Speaking of the 1970s, let me draw a parallel that matters for understanding where we might be right now. The last time physical silver supply was this constrained, the world was dealing with a monetary system under extreme stress. The Bretton Woods framework had just collapsed. Currencies were being repriced against hard assets in real time. Inflation was running hot. And in that environment, silver went on a run that people still reference 50 years later. History tends to rhyme rather than repeat exactly. But the structural ingredients that existed back then and the ones present today share unmistakable similarities. Supply constraints, inventory drawdowns, demand outpacing available metal, a monetary system facing questions it has not had to answer in a very long time. These are the conditions that historically precede explosive moves, and that history leads directly to the most important warning in everything I'm going to share today. This market is capable of truly violent moves to the downside, not slow, manageable declines. The kind of move that flips your portfolio before you have time to react. We already saw it once in this very cycle. A 28% single-day crash. If you had $100,000 in silver exposure when you went to bed, you woke up with $72,000. Not because supply fundamentals changed, not because a massive new mine came online, a single personnel announcement, the nomination of a new Federal Reserve chair. One piece of news about who might be running the central bank triggered the largest single-day decline silver had seen in years. That event tells you something absolutely critical about the current market structure. Yes, the fundamentals support higher prices. Yes, the technical path is clear. And also true is that this rally is being driven in significant part by liquidity flows and sentiment. Liquidity flows can reverse in minutes. Sentiment can shift overnight on a single headline. The same momentum pushing silver up at breathtaking speed is capable of pushing it down with equal brutality if the narrative changes. This is the trap that is going to catch thousands of people who are completely right about the direction of silver, but completely wrong about how they are positioned. Being right about where price goes eventually does not protect you if leverage causes a margin call right at the bottom. The market does not reward being right. It rewards being right and being positioned in a way that allows you to stay in long enough for the move to actually play out. So let me be direct. If you are in silver or considering it, no leverage, none. Not in this environment. Position size that lets you sleep through a 20% drawdown without feeling the urge to react. A clear time frame about whether you're a trader or a long-term holder. And a written plan about what would actually change your mind on the thesis. Because if those things are not in place before the next violent shakeout arrives, you will make decisions under pressure that you will regret the moment that pressure lifts. Let me ask you something personal. When silver dropped 28% in a single session earlier in this cycle, what did you actually do? Did you panic and sell? Did you freeze? Or did you see it as an opportunity and add to your position? Your honest answer tells you more about your real psychology than any analysis I can provide. Drop it in the comments. Not what you think you should have done, what you actually did. Because knowing yourself, honestly, is the most valuable edge you can carry into a market like this one. Now let me walk you through the specific technical levels that matter, because in a market this volatile, structure is everything. The $91.33 level is the most important line on the chart right now. That is the former resistance that flipped into support. As long as silver holds above that level on a daily closing basis, the bullish structure remains intact and the path to 100 stays open. The moment silver breaks below 91.33 without strong buying stepping in immediately, you have a clear warning sign that current momentum is failing. Immediately above current prices, $95 is the next psychological barrier. This is the last meaningful checkpoint before triple digits. Watching how silver behaves when it tests that level will tell you a great deal about the quality of this move. Does it push through with strong volume and conviction, barely pausing? Or does it stall, reverse, and start hunting for stops below? The character of that test gives you early information about whether 100 is coming in the near term or whether the market needs to consolidate first. Above 95, technical projections point toward $104 as the next significant structural target. One additional technical factor worth understanding is the relative strength index sitting near 70. Overbought does not mean price has to fall immediately. Some of the biggest moves in commodity history have happened with RSI pinned above 70 for extended periods. But what overbought conditions reliably produce is increased volatility. Sharp, fast wicks that hunt stop losses. The kind of sudden intraday swings that trigger people out of positions right before price resumes higher. Expect that kind of action, especially around Monday market opens. This is not pessimism, it is just how these markets behave when momentum gets extended and emotions run high. Now the geopolitical layer, because there is no honest way to discuss what is driving silver without addressing what is happening in the Middle East. Large-scale military operations are underway involving multiple regional powers. Major infrastructure and military targets have been struck. The language from senior political figures is not the language of a contained situation. It is the language of extended timelines, acknowledged costs, and stated intention to continue until objectives are achieved. Markets are responding exactly the way they historically respond when the world's most volatile region becomes significantly more dangerous. Capital moves toward assets that carry no counterparty risk, and silver is capturing those flows at a rate that is actually outpacing gold. Gold rose approximately 3.5% during the most recent major spike. Silver jumped nearly 13% in the same window. A 4-to-1 ratio of outperformance. That tells you something important. Investors are not just seeking safety, they are seeking leveraged exposure to the precious metals complex. The money flowing into silver right now is positioning for significant upside, not just parking there for short-term preservation. But here is the complication with geopolitical rallies. These price spikes are among the fastest to reverse. If a diplomatic development emerges over a weekend, if de-escalation signals hit the news when markets are closed, the repricing Monday morning can be extremely sharp. After an initial spike, any positive diplomatic headline could trigger profit-taking severe enough to feel like the entire rally is finished. The speed of a potential reversal is something you need to have a plan for before it happens, rather than scrambling to figure out in real time. This is why your time frame and position sizing need to be aligned before the headline risk hits. If you are a short-term trader, tight stops and quick decisions are not optional. They are survival. If you are a long-term holder accumulating precious metals as a hedge against monetary instability, short-term volatility is noise on a longer signal. Pullbacks become buying opportunities. But you have to genuinely be a long-term holder. You cannot claim that identity while holding a position so large that a 15% drawdown forces your hand emotionally. The dangerous place is somewhere in between without knowing it. The market finds that contradiction and exploits it at exactly the worst moment. What are the institutions doing right now? Deutsche Bank has flagged that the current gold to silver ratio of approximately 57-to-1 presents significant upside risk to their $100 per ounce forecast for silver. At 57-to-1, silver is relatively cheap compared to gold based on historical relationships. If that ratio compresses toward the 40-to-1 range that has marked previous bull market peaks, silver has substantial percentage upside from current levels. Meanwhile, serious long-term physical accumulator Eric Sprott has gone on record, warning that if the physical supply drain continues, we could see a revaluation event targeting $300 per ounce. Is that guaranteed? Absolutely not. But when someone with that level of access to real supply and demand data says that publicly, it deserves serious consideration. The smart money is not positioning based on hope. It is positioning based on fundamental analysis of what the supply constraints, demand trajectory, and monetary dynamics actually imply for where price eventually needs to go. At its core, what is pushing the silver rally is dollar weakness. The dollar index is declining because Treasury yields are falling. Falling yields reduce the opportunity cost of owning silver. Lower opportunity cost brings capital out of dollar assets and into precious metals. That chain of causation is clear, and it is currently running in silver's favor. But flows can reverse. What could reverse the current flow? Any credible signal that the Fed is moving more hawkish? Inflation data suggesting rates need to stay elevated longer. An unexpected strengthening of the dollar. Geopolitical de-escalation, removing the safe haven premium. None of these are predictions. They are known risks embedded in the current setup that you need on your radar at all times. People often ask why silver can be pushed lower by large paper sell orders if the physical fundamentals are this bullish. The answer is timing and mechanism. Paper markets move at the speed of a click. Moving physical silver requires logistics, verification, documentation, and time. A large paper sell order can push price wherever the seller wants in the short term because paper supply is theoretically unlimited. You can sell silver futures representing metal you do not physically own. But this only works as long as participants accept cash settlement. When someone sends a 159 million ounce order into a market, where 60 million ounces are deliverable and the system freezes, you are seeing the limit of that mechanism in real time. Paper selling can hold price below fundamental value temporarily. It cannot do so indefinitely against genuine physical constraints. Eventually, the paper price has to reflect physical reality. And historically, that adjustment is fast and forceful. So when you see a sharp paper-driven sell-off in a tight physical market, you're looking at an opportunity, not a refutation of the thesis. The question is whether you have the conviction to act when everything feels uncomfortable. Let me walk you through what I will be watching this week. Monday's open is going to be extremely informative. After a full weekend of geopolitical news, we are almost certainly going to see gap action when markets open. How that gap behaves in the first 2 to 3 hours tells you a great deal about conviction. If price stabilizes above 91.33, bulls are in control. If the gap down extends and price struggles to recover, that warrants close attention. The $95 level is the immediate test that matters most. If silver pushes through with strong volume and minimal hesitation, the runway to 100 opens clearly. If 95 acts as a hard ceiling, we are likely entering consolidation before the next leg. Below 91.33 is where things get complicated quickly. If that support breaks on a daily close, price could accelerate toward the $75 to $77 range that provided the previous floor. That would be a significant drawdown that tests conviction in ways that feel very real when you are living through it. The framework I use personally for telling the difference between a dip that is an opportunity and one that is a warning is built on 3 things. First, what is the dollar doing during the silver sell-off? If the dollar is strengthening meaningfully, the macro flow is reversing, and that is a warning. If the dollar is flat or still weakening while silver dips, the drop is probably technical and tends to resolve back in the direction of the trend. Second, what are physical premiums doing? If paper prices drop but physical premiums stay elevated, the physical market does not believe the sell-off and the dip is likely temporary. If physical premiums collapse alongside paper prices, demand at the physical level may actually be cooling. Third, what is the volume character? High volume drops suggest real distribution where large participants are exiting. Low volume dips into support suggest stop hunting rather than genuine selling pressure. When all 3 factors align, dollar stable or weak, physical premiums holding, and dip volume thin, you have a high probability accumulation setup. When factors diverge, more caution is warranted regardless of how compelling the bull case feels in the moment. Silver has cleared a significant technical structure. The path to 100 is open in a way it has not been at any point during this rally. The dollar dynamics are providing real fundamental support. The physical market is genuinely tighter than it has been in 50 years. Institutional money is positioning for significantly higher prices. And geopolitical risk is accelerating safe haven flows into silver specifically. The setup is as compelling as it gets in a commodity market. And also true is this: violent pullbacks are part of this market's DNA. Paper selling can push prices wherever sellers want temporarily, regardless of physical reality. Geopolitical rallies can reverse sharply on a single headline. The liquidity flows driving this move can change direction faster than most people can react. Both things are simultaneously true. The opportunity is real and the risks are real. Your job is to size your position in a way that allows you to stay in through the volatility and actually capture the opportunity you came here for. The $100 target is viable. The path is technically clear. The fundamentals are supportive. Whether silver gets there in 3 weeks or 3 months, or whether it needs one more major shakeout first, Nobody can tell you with certainty. What I can tell you is that the structural setup is in place in a way that is genuinely rare. Missing it because you were waiting for a perfect low volatility entry is not a strategy. That entry does not exist in a market like this. Know what you own, know why you own it. Know what would actually change the fundamental thesis rather than just what would scare you temporarily, and have a written plan for the various scenarios that could unfold this week and this month. A mental plan evaporates under pressure. A written plan holds when the volatility arrives. Before I go, I want one thing from you in the comments. Do you think silver hits 100 before this move is done? Or do you think we need one more significant shakeout to flush out the late buyers first? Tell me what you actually believe. And if you have had any real success accumulating precious metals over the past year, share that story. Even a small win helps people who are still building confidence see that patience and discipline actually produce results in real life. If these breakdowns are giving you a clearer picture of what is actually happening in these markets, make sure you are subscribed to Element Axis so you never miss an update when things move fast. Hit the like button because it genuinely helps more people find this content when they need it most. And share this video with someone in your life who has been watching silver but is not sure what to make of the current move. They need this analysis right now, not 3 months from now when the opportunity has already passed. The market just gave us a signal. The structure is clear. The question is whether you are positioned to benefit from what comes next, or whether you become the exit for someone who understood the setup earlier and better. I will see you in the next one. Stay focused, stay disciplined, and never let the volatility make your decisions for you.